Welcome to today's webinar. We're really excited to be able to present this to you, this special webinar presented by Rakesh Bhargava of Mango Tree Real Estate Holdings, and he'll be talking about how to cut your client's tax cost 3 ways with opportunity zone investing. So once again, thank you for joining us today. We're looking forward to a really interesting topic and a really interesting hour for all of you coming up here. A couple of housekeeping tips or housekeeping items. Let's talk first about tips for using GoToWebinar. If you're not seeing the GoToWebinar control panel, look for a little orange arrow. That arrow will expand or hide the panel at any time. If you'd like to view your 2 audio options, you can select the audio tab and it'll provide you with the options for computer audio or phone call. If you select phone call, it will give you a call-in number and an access code to be able to listen in. If you haven't yet downloaded Rakesh's handouts, you can go to the handouts tab and you'll find today's PowerPoint ready for downloading. If it doesn't download right away, just give it a few minutes. We've got a lot of people trying to hit that PDF at the same time, and that can sometimes slow it down. So please bear with us, but it will be downloadable. If you don't get it for some reason, you can email us afterwards, and we'll be happy to send it out to you as well. And finally, if you have any questions for Rakesh during the presentation, please go ahead and type them in at any time, and we'll try to get to some questions during the poll breaks and at the end of the presentation as well. So you can simply go to the questions tab, enter in your question, and then make sure to click the send button to make sure it comes across to us as well. We do offer 1 CP for today's webinar, and that's based on active participation during the webinar. Active participation means 3 things: attending the live webinar for no less than 50 minutes, responding to all of the polling questions. Today there will be 4 total polling questions, and the first one is actually just about 2 or 3 minutes away here. And finally, submitting the post-webinar survey after the webinar ends. So as soon as you close out of the webinar window at the end of Rakesh's presentation today, you're going to see a post-webinar survey window pop up from GoToWebinar. You just go ahead and fill in those questions, click submit, and you're done at that point. If you don't see the post-webinar survey come up, no worries. We will send you a follow-up email, and that will include another link to it as well. We will notify you by email about your CP eligibility. And the other thing we want to mention is if you don't already have webinar@accountantsworld.com added to your trusted email list, please go ahead and do that to make sure that emails from us related to webinars are able to come through. So before I turn things over to Rakesh, I wanted to go ahead and just talk a little bit about our sponsor today, Accountantsworld, and then also a little bit about Rakesh. So here at Accountantsworld, we're really proud to be able to bring webinars like this. I know many of you know us for our expert webinar series. Last year, we had 16 experts, 12 of whom are in the Accounting Today Top 100 Most Influential list, presenting on a variety of topics, and we're going to be doing that throughout the year this year as well, starting in late April or early May. And today's webinar is another example of our commitment to you. And what really sets Accountantsworld apart is that we only have one focus, and that is what's best for professional accountants and will best allow professional accountants to serve their clients. So we provide award-winning professional solutions, and I'll talk just a little bit more about that in a second. But we also provide everything else that we think can help you to be more successful. We provide support for both your technology and for your practice. We provide webinars like this one. We provide webinars related to our products as well. We provide ebooks and guides to success. So we provide information on how to make your payroll practice more successful, how to diversify your accounting offerings in order to be able to better serve all of your customers, how to customize your services for each client, how to communicate with your clients, etc. So that's really what we're about in a nutshell. In terms of our 2 flagship products, they're in accounting and payroll. Our accounting solution is called Accounting Power, and the core theme behind Accounting Power is that most accounting solutions put the client in the center of client accounting, and we think that doesn't make any sense at all. The client is not the expert, you are, and we want to give you the tools to not only be able to serve your clients as well as possible, but to also customize your offerings for every single client. So the accounting power model puts you, the accountant, back in the middle, in control. It allows you to customize every accounting engagement, including those who want to offload all of their accounting work to you, so that you can offer them client accounting services, those who want to still do some of the work in their offices, and those who may still need to write manual checks as well. So we're the only solution that's built to allow you to be able to serve all those diverse client needs within one solution. Accounting Power has received, as you see, an exceptional rating from CPA Practice Advisor, and we have 5-star reviews on Capterra as well. On the payroll side, Payroll Relief has been 5-star rated by CPA Practice Advisor for 5 years in a row. We're the only payroll solution built for professional accountants that's been able to achieve that. And the key to Payroll Relief is unprecedented automation. We automate virtually all payroll processing tasks, allow you to perform those automatically on time and with 100% guaranteed accuracy on computations. Payroll Relief also organizes your workflow to follow the natural sequence of payroll processing. And just like on the accounting side, Payroll Relief allows you to customize your payroll service to best meet the needs of each client. So what I'd like to do at this point, I know many of you are busy in the middle of tax season right now, but hopefully that quick overview of Accounting Power and Payroll Relief resonated with many of you in terms of being interested in learning what they could offer to you. And we offer a brief demo, a live demo, which will allow you to learn more about our accounting and or payroll solutions and how they can specifically help your practice to thrive. And so I'm going to go ahead and launch the first poll question here, which you should be seeing in front of you right now. And the poll question is, in 15 minutes, Accountantsworld can show you how to improve your accounting and payroll services. Are you interested in being contacted this week to schedule an accounting demo or a payroll demo? Or if you'd like to wait until after tax season because you're too busy right now, that's fine as well. Just go ahead and indicate that for either accounting or payroll. Or you can indicate that you don't have any interest in improving your accounting or payroll services at this time. So I'll give a few seconds here. Let's give about 10 to 15 seconds for people to go ahead and vote. And just a reminder, this is a required poll question. So even if you're not interested, please go ahead and indicate no interest to make sure that you get credit for that first poll question. This is the first of 4 poll questions that we'll be having today for attendees if you'd like to be able to earn CPE credit. All right, so I see 90% of people have voted, so we'll go ahead and give just 5 to 10 seconds here for the stragglers to go ahead and get in. And a reminder, this is required in order to earn CPE credit today. All right, we are going once, going twice, and we are closed. Okay, thank you so much for voting in that poll. And at this point, we will go ahead to Rakesh Bhargava. So I'm going to give a brief introduction before I turn it over to him. Rakesh is the managing member of Mango Tree Real Estate Holdings. And in that role is a leading authority on investment opportunities from the purchase and improvement of distressed real estate. And Rakesh is a serial entrepreneur. He has founded or funded 8 different businesses and counting. And so I'd like to bring in Rakesh at this point and welcome him to our presentation. Rakesh, are you there?
Yes, I'm here. Good day to you and to all of our listeners.
Sounds great. And so Rakesh, I'd love to get the ball rolling by asking, tell me a little bit about your interest in presenting this topic to our fine audience today.
Okay, so thanks. That's a good question, Dev. So what happened in about 30 years ago, I started a practice of doing technology consulting, but specifically with automating accounting systems. And I did that for about 12, 13 years and then sold it to American Express /GGK and become a principal or a partner there. And I have been using the Accountantsworld software, starting with tax relief, almost for 30 years now. And one thing that I one thing that I took away from their value-driven approach to their customers or their clients is they are there to support them. And recently, I graduated from Goldman Sachs 10,000 Business Owners Program, and I learned that our power comes from our peers. All of us are better than one of us. So I felt that this is a new opportunity, pun intended, where clients can save an enormous amount of money, and I can demonstrate that shortly. So I thought it would be a good idea to share what I have gotten as a gift, so to speak, from Accountants World with the rest of my colleagues who are my fellow clients. So that's the driving force behind it.
That sounds great. So Rakesh, I think we've got your presentation up and running at this point.
Yep. Okay. So, by the way, feel free to ask any questions you might have, and if it's not a part of the slide, then I will definitely take a moment to stop and answer them. So, the first slide is our disclaimer, which basically is standard because we do have a company that is a limited partnership, and so as part of the disclaimer, you can read it. Now, today's agenda basically, I'm going to cover uh, three things. One is what are the opportunity zones, and you will get a definition from me. That's you can deploy it and understand what they are, where they are located. And there are three ways the capital gains tax costs are reduced. And if nothing else you walk away from this presentation, if you just took these three things, you will see that it offers an enormous tax benefit, and we will also see a live example of it. So first is to defer, meaning the taxes that are due now, you can defer it until the end of 2026. Reduce, if you stay invested in those properties, in 5 years, you get a 10% step up basis. In 7 years, you get a 15% step up basis. And eliminate, which is probably very powerful, is after 10 years of being invested in the opportunity zone investment, you eliminate all the gain on gain. So to me, these are very three powerful tax benefits that are offered to people who are going to invest in areas that they normally would not invest. And lastly, I'll talk a little bit about how to invest, the structure and what is allowed, what is not allowed. Okay, Dev? Okay, so what are the opportunity zones? So number one, this is the definition that the economically distressed communities where new investments um, are under certain condition may be eligible for preferential tax treatment, the tax treatment which defer, reduce, and eliminate. And these are officially designated low income census tracts eligible for favorable capital gain tax treatment. And these opportunity zones were added to tax code by TCJA on December 22nd, 2017. And so far, there are 8761 opportunity zones that have been identified in all 50 states, DC, and 5 US territories, including Puerto Rico. And by the way, the entire island of Puerto Rico is an opportunity zone. Approximately 12% of the land mass of USA is included in the opportunity zone, and roughly 25% of all economically distressed communities sort of constitute the opportunity zone, just to give you a broad landscape. And there are maps available online. I will also give you a link to that map that you can put the address of the property to see if that property is in an opportunity zone or not. So let's talk about the three tax benefits. So number one tax benefit is that you can defer, or your clients can defer, capital gain taxes which are due now if they sold a property, let's say in December, or actually go back 5 months of 2018. And they can be deferred until you sell your property or sell your investment, or December 31st, 2026. But you must do so by investing in a qualified opportunity fund. For your reference, I've given a glossary of these terms at the end of the presentation. So let's say you have $1 million of gain, and let's say you're in New York State and the tax is roughly 30%. So on that $1 million gain, you have $300,000 worth of gain that you can keep it for 7, or in this case 8 years, till 2026 and you can let the money earn money for you as opposed to the government. So that's the first benefit. Second benefit is that reducing the basis or eliminating the 10% of investment gain if you held the investment in the QOF for at least 5 years. or an additional 5% or total of 15% if you keep the property or you keep the investment for 7 years. So what happened is that if you have $1 million gain and if you invested in a business or invested in stocks in an opportunity zone, after 7 years, you have a reduced gain, meaning you're paying gain tax on $850,000 or 85%. So there's this second benefit. You're reducing the tax on the gain. And lastly, after 10 years upon the sale of the asset, any appreciation on that gain, on that initial gain, it is completely tax free. Or if you sell it earlier, you can just roll it into another QOF and it remains tax free. So these are the three ways you can advise or guide your clients to reduce their overall capital gain tax. Now, another, I'm sorry, Divya, you have a question?
Oh, I'm sorry. I was going to mention, should I go ahead and launch the second poll question at this point?
Mhm.
All right. So let me go ahead and get that poll question up here. So this is going to be a little bit of a recap of what Rakesh has just presented in the previous two slides. So the question is, what are opportunity zones? Please select one of the following: investment opportunities in economically distressed areas, designated low-income tracts eligible for tax incentives, comprising over 12% of the land mass in the US, or all of the above. So please go ahead and select an option there. And Rakesh, while people are voting, a couple of questions that have already come in. One from Edward. In order to eliminate entire gain, it sounds like you would sell in 2029 or later. Doesn't this project end earlier than that? Rakesh, are you still there?
Okay, so can I go? Okay, so
Did you hear the question? I can repeat it if you'd like.
yeah, go ahead, please.
Okay. So the question was, in order to eliminate the entire gain, you would sell in 2029 or later. Doesn't this project end earlier than that?
Okay, so that's a very good question. So you have the opportunity zone designation remains intact for 10 years. Not only you will see that in later slide, not only you can sell it after 2029, but you can sell up to 2047 to get the same benefit.
Okay. And then one other question, I believe Anne Mass asked, can these tax benefits be applied to corporations as well?
You're not coming clear, Divya, for some reason.
Dave, your microphone's cutting out a little bit.
Oh, sorry, let me adjust it here. All right, can you hear me now?
No.
It's still not good.
Okay. I'm going to go ahead and close the poll in just a couple of seconds here and turn it back over to Rakesh.
Sure.
All right, so folks, if you haven't voted yet, please go ahead and do so now, and then I'll turn it back to Rakesh. All right, going once, going twice.
Okay, so the last point I was making is that, and I don't have data on every single state, but some states are conforming to the capital gain treatment to the Tax Cut and Jobs Act. Some like California are not conforming. Some like Florida have added new incentive programs to go along with it, and New York and New Jersey are participating. Okay, so let's take an example of what kind of savings we're going to get if we invest in opportunity zone. Okay, so number one, I have certain set of assumptions that I put on this slide. And number one is that let's say the capital gain realization happened on December 1st, 2018. The amount of gain is $100,000. This is purely gain, not the money you originally invested. And the combined federal tax and the surcharge is about 23.8%. And let's say the client or the investor made this investment on January 1 of 2019. So let's see how the numbers shape up. And I'm going to go line by line on each one of these slides. So let's say we started with both $100,000. And what is happening here is, so these are the 100,000, the original investment. I have two columns, one traditional, one invest in an opportunity zone. At the outset, the traditional investment will attract a tax of $23,800. So what is left to invest is $76,200. In opportunity zone, you are investing the entire 100,000 right into the investment. Let's fast forward to 2026. There is no tax under traditional plan because tax wasn't deferred. You paid it. Then you had to pay 20,230, which is the 23.8% of the 85% of the original gain amount, which in this case is $85,000 times 23.8%. And the Excel shows that we are 20,230. Now I'm at an assumption here that the the client or the investor is making an additional investment of 20,230 here and making the same investment here. So, and then I have accumulated 8% interest on that amount. So let's go forward to 2029. The property is sold or the business is sold. The federal taxes that have to be paid because it's a traditional plan is 22,268. The federal taxes total that are paid is 46,068 right here. However, in our opportunity zone case, we only paid $20,230. Total savings is 25,838. Then what I did is that I took 8% compounding for 10 years, and on the $76,000 became 189,994. And here the 100,000, and by the way, this I added 20,230 in the 8th year. And then here the 100,000 become $215,000. We took out the original gain from this total sale proceed. So in this case, I took 100 plus 20,230 minus the tax that was paid, and it gives me an initial capital gain of 96,430, and here it is $100,000. The gain in traditional method is 93,564. The gain in an investment in opportunity zone give us $115,000. So the difference of this $22,000 plus this 20 some odd thousand dollars and this 20,000 gives us an advantage of 48,166 investment that is made in opportunity zone as opposed to traditional. So at 8% compounded, you walk away with roughly 51 or 52% gain over a traditional plan. Okay, I know it's maybe a lot to digest, but you have this spreadsheet. I'm also planning to build a calculator that is going to be a little more comprehensive and which will allow you to plug in the state number and federal numbers and marginal tax rate, and hopefully we can get that done. So you have an actual way of doing some sort of an illustration to a client, but in a better way. All right, let's move forward and go to the next slide.
Hi, Rakesh. We're not hearing you right now.
Sorry. Okay, so am I back online, Dave?
Yes, you are.
Okay, sorry about that. So the US, the law became effective December 2017. The US Treasury proposed regulations. There are about 74 pages of them on October 26, 2018. And I will have a link for you at the end of the presentation, so you can download those regs if you want to read it. The next thing is that the public comments were due by December 28th. Roughly, they got over 150 comments. And public hearings that were supposed to be held in January, they are still not held, and they're still waiting for clear guidance. So this is the rough timeline for the proposed regulation and what's going on. And I also gave you a link to the regulation here. Okay, now these are the critical deadlines for tax planning purposes. So number one, any realized capital gain must be invested in a qualified opportunity fund as follows. For any individual, they have to invest within 180 days from the date of the realized capital gain. Now, please note, if the 180 days falls on Saturday or Sunday, you need to make that decision, make that investment by Friday. There's no extension, or it doesn't fall on the following Monday. And they are very strict about 180 days. So my suggestion would be, think of 160 days or 150 days to make the investment. That's the safe date. Any pass-through entities which is issuing K1 to their partners, for those partners, if the pass-through entity elect to defer, not to defer the taxes, then you have 180 days from the end of the year of that entity's tax year. So say, for example, if a partnership sold a property in February of 2018 and you did not know about it until you got a K1 in March, your 180 days starts from December 31st, 2018. Now, for any real property, the QOF, Qualified Opportunity Funds, must consume capital in the Qualified Opportunity Zone within 31 months. What that means is that a cash is not considered investment except when you have a written plan that clearly demonstrate how are you going to deploy that capital within 31 months. And you need to have a written plan filed with into your files, and make sure that you comply with that written plan. Next is that the designation expires at the end of 2028. So you have 10-year window in which you can continue to make the investment. Now, 2019 is the best year to make the investment because you get a 15% reduction. But if you make the investment, let's say in 2020 or until 2026, you can still defer 10% of the tax on the gain. You must finally sell the property by the end of 2047 to enjoy the benefit of complete elimination of the tax. So these are critical deadlines for the tax planning purposes. Okay, now how to invest in opportunity zone. So any individual or any pass-through entity, they must invest through a qualified opportunity fund. You cannot invest directly into a property. You need to create a fund. The fund can either be a C corporation or a partnership, but S corporation is not allowed. You must self-certify filing with the IRS by filling out the form 8996, a draft of which, along with the instruction, is available from IRS website. So the self-certification is critical to this. Now, as I said in the past, a qualified opportunity fund must hold 90% of its assets in a qualified opportunity zone. So say, for example, you have $1 million of gain, 900,000 of it must be invested in an opportunity zone. 10% you can leave it as cash or invest somewhere else, any stock, bond, or any other asset. Every 6 months, a fund must perform an asset test to make sure that it's in compliance with the 90% rule to avoid penalty. In order to do this, you must first designate a month. Let's say you started the fund in July or in June of 2019. So you must choose June as the first month, and then every 6 months you're going to take the assets, either audited or at cost, to make sure that 90% or plus is invested in the qualified opportunity zone. Now, interestingly, and there is not 100% clarity on it, if a qualified opportunity fund is investing through a subsidiary, then they must invest more than 70% of its asset in a qualified opportunity zone business property. This is basically substantially all of the asset clause, and I am not 100% sure how it's going to work out because there's no clarity on it. But if that's the case, then if you invest through a subsidiary, then no more than 63% of your assets can be invested in qualified zones, and 37% can be invested somewhere else. If you already have an existing entity, you can still take the advantage of opportunity zone investing by self-certifying. Okay. Now, what kind of investments qualified for this triple tax benefit? So number one is you can invest in a corporation, in a stock, in a partnership interest, or a business property. all kinds of investment are allowed. The only caveat is that you cannot take an existing investment that is sitting in an opportunity zone and treat it as an investment. You must bring new machinery, for example, new equipment, new building, anything that is outside the zone into the zone to qualify for the tax benefit. Second thing, any residential or commercial real estate, as long as the real estate is newly constructed or acquired after December 31st, 2017, meet the criteria for tax benefit. In case of real estate, what is critical is it has to be substantially improved to meet the eligibility requirement. What that means is you have to invest 100% of the cost of the structure and invest that money in the rehabilitation. Say, for example, you bought a building for $100,000, 80,000 is structure, 20,000 is land. You must spend that $80,000 over the next 31 months for you to qualify it to be a qualified business opportunity zone business property. This is very important. You have to make an equity investment, meaning money at risk. You cannot grant a loan out of your capital gain and treat it as and it doesn't qualify for tax benefit. You cannot invest in any sin business, and I've given a list of it here, which is pretty standard. So these in businesses do not qualify, but you can open a pizza store. Now, liquor store is not allowed, but a restaurant that serves liquor is okay because liquor must be consumed on the premises. Okay, I also a little bit want to talk about our expertise in opportunity zone like property. So
And
over the last, yeah,
if you don't mind, I can go ahead and do the third poll question, and then we'll
sure,
do the
please go
fourth
ahead.
in just a
Please go ahead.
slide or
Thank you.
two here. And I'll take a couple of questions as we do this one as well. So folks, the third one should be open in front of you right now. And the question is, true or false, opportunity zones are located only in low population areas, true or false? Select one of those. Make sure to click submit so that your vote is counted. Couple of questions. Joyce asked, can an area be classified as an opportunity zone today and later be unclassified? Could you lose the opportunity zone benefits if that were to happen? Rakesh, I can't hear you right now.
Hang on, Dave. Could you repeat that question for Rakesh?
Yep. The question was, can an area be classified as an opportunity zone today and later be unclassified? Could you lose the opportunity zone benefits if that were to happen?
Okay, so Dave, your question was that if a property or an opportunity zone is classified as an opportunity zone and can it be later disqualified? So once designated, that designation remain with that zone for at least 10 years.
Okay.
So that cannot be taken. Also, I got 2 or 3 more questions. If you don't mind, I can respond to them right now.
Sure.
What are the risks associated with the opportunity zone? So obviously these are economically distressed areas. These are not like midtown Manhattan or downtown San Francisco or LA. I mean, they are not like fancy areas. So obviously there is a risk associated with this neighborhood. The whole idea of for the government to give the tax incentive is to bring the capital into these areas which otherwise would not consider going in there. So they're incentivizing you to bring the capital into a risky area. Therefore, it is very important to examine the investment carefully. If the investment makes sense, then the tax benefits are sort of like a cherry on the top. But I would not make any investment in any property or any business if the business does not have a solid leg to stand on its own. That's very important. To make an investment based on the tax benefit can come back to haunt us. Second question somebody asked is that can it be a loan? And one of the slides I did mention that it has to be equity investment, meaning your money should be at risk, not a loan.
Okay, great. And so we'll go ahead and close up the polling here in about 10 seconds. If you have not voted, please go ahead and do so. One other question we'll go ahead and take while we're waiting here, Rakesh. Daniel asked, is there any way to invest in a current business operating in an opportunity zone?
Yes, a existing entity can qualify, but that transaction has to be at the arm's length. So for example, I have currently 6 properties in opportunity zone. I didn't know they are going to be in opportunity zone. I bought them, a couple of years ago. So today I cannot say that, oh, they will classify as an OZE property. No, somebody at an arm's length buy that property, buy that business, and invest in it. So that's one option. The second option is if you take shares in that business. Say, for example, I have a pizza store in a street in Newark or a street in Wyandanch, and I wanna expand. I want to bring new stove. I want to bring new furniture. I want to spruce up my pizza place. So what could happen is I can get somebody, Daniel, to be my partner, and I can say, Daniel, this property is worth $100,000. You put in another 100, I give you 50% ownership. That 100,000 that comes in allows me to buy a new stove, allows me to buy new chairs, new furniture, and yes, then it qualifies. But I must self-certify it on Form 8996.
Okay, sounds great.
Okay.
I've gone ahead and turn it back over to you. And folks, we'll do the fourth poll question in a couple of slides here.
Okay, so the next, I just wanted to share with you because people have asked about risk and what my experience has been investing in this property. So I prepared a little chart. I went back to all the properties I bought and I sold, and I come up with a little profile, and I divided the opportunity zone by certain distance. So I had 9 properties in now designated opportunity zone. The purchase price, rehab minus the sale price gave me a gross return of roughly 34.5%. Okay. The second is less than a mile. I had 20 properties and our gross return was roughly 32%. Then we go less than 2 miles from an opportunity zone. We had 16 properties and our gross return was little over 33%. And then we had less than 4 miles, we had 22 properties and the gross return was like 32%. So you can see that we averaged somewhere around 32% gross return before all our G&A, selling, marketing, all those expenses. Then I created a chart as to what happens if the properties are more than 4 miles. So I have 68 properties that are more than 4 miles, and our return was 30%. So you can see that there is a slight advantage if you carefully select the properties in opportunity zone, because there is a high barrier to entry, meaning a lot of people would not go there because of the condition of those properties. So you need to have a domain expertise in those areas to get the benefit from this property. Again, these are my past numbers. There is no guarantee that I can repeat them in future. This is just to illustrate to people what's going on in these areas and in these properties. I have another chart that talks about the same thing in a different way, which is just to instead of a circle like on a bar chart. Then this is our track record overall in Mango Tree. And let me just see, I lost that slide. Okay, so we have been in business since 2010. We have invested in 90. We have 91 partners, and our total capital is a little over $20 million. Okay, so this primarily concludes the seminar. I'm open to a lot of questions, and people can ask me anything they want to ask, and I'll try to respond to them as much as I can.
Okay, and what I'll do is go ahead and launch the fourth poll question here at this point, and then we have some questions that have already come in. Attendees, if you have other questions, please go ahead and put those in here as well. So the fourth poll question, and this is a select one or more of the following. Which benefits of opportunity zone investments matter most to you and your clients? The longer an investment is held, the greater the tax benefit. This is a new investment opportunity. Ability to invest capital gains in a QOF up to 180 days later. Qualified OZs are located in all 50 states, or any tax-paying individual or entity can create a QOF. So please go ahead and select any of those, or as many as you would like, and make sure to click the submit button as well. Let's see. Question from Jeffrey. Please clarify, can you use debt for a purchase and capital gains as equity piece of the capital stack in an opportunity zone property purchase?
It's an excellent question. It's the challenge when I started making this presentation is that there are a lot of unanswered questions and a lot of questions that I have the feedback from the experts. And so I did deliberately include a lot of these questions, but Jeffrey's questions is very good. You can use equity and debt to buy into an opportunity zone property. So let's say you're building a hotel for $20 million, you put in $5 million of equity and you borrow $15 million. That 5 million would be entitled to get three benefits we talk about, not the $15 million. Same way, after 3 or 4 or 5 or 6 years, you can refinance the property and distribute the cash to the extent of basis that people have in the property, and there is no tax consequences to it. That's my understanding of the refinance and also taking the loan to go forward.
Okay. One other question from Peter. Can the gain realized inside a partnership be reinvested into a newly established partnership owned by the same partners?
Yes, you can do that. I think the the question is that if you can take the existing partnership interest, sell it and reinvest the gains into this same. So there are a couple of thoughts on it. My personal opinion is that if you already have a property and you have a 10-year time frame, after 10 years you need to sell it. If you're making another investment, create another LLC just for the clarity's sake, and it's just clean way to do that rather than investing in the same partnership. But an attorney probably can answer this question better, but you can do that. My understanding is that you can.
Okay. Um, Nathan asked, what basis is subject to the 10 or 15% step up, the original basis or the adjusted basis on first sale?
Okay, so Nathan, that's a good question. So let's start with a example. Let's say I invested $100,000 into a business, and in 2018 I sold that business for $500,000. So I have a $400,000 worth of gain. Unlike 1031 exchange, you can take that $100,000 and buy a new boat or buy a new car. It doesn't matter. This 400,000 with zero basis can be invested in a qualified opportunity fund. So when I talk about reduction in taxable income or step up basis, I'm talking about this $400,000 that you get 10% and 5% benefit after 5 years and 7 years. I hope it's clear to Nathan.
All right. And folks, just a reminder before I go to the next question here, if you haven't voted in the poll yet, please go ahead and do so. Poll question is still open right now. Mark asks, can an investor have some or all of their investment in a QOF returned to them at any time?
Yes, they can. The investment can be returned, but then it will be subject to the taxes applicable at the time. My suggestion would be that if there is an extreme hardship or something, yes, I think the provision would be to get the money, but then you will have to pay taxes on it. I think I have illustrated it 2-3 places that if you liquidate before 10 years, you will not get the benefit of 10-year tax elimination. If you liquidate before 5 years, you will be subject to the taxes and appropriate interest and penalty. Another way would be that you can refinance the property or refinance the business or take a loan on the business and then take care of the cash requirement that way. Okay, do I see some questions here? So should I go ahead and pick one? Okay, so Divya, can I go ahead and start answering the question?
Yes, you can select any of those you'd like to.
Okay. So first question that I have is that by George, is money in an existing property located in opportunity zone by the same owner? I responded to say that no, the owners, anybody who owns more than 20% of an entity cannot take the benefit of an existing property. It has to be a new acquisition. So that answer is no. Glenn had a question is that Mango Tree's investment platform being acquisition and rehab of distressed property, is the construction cost equaling or being more than the structure cost that qualify? Yes. So Glenn, that's a good question. And my example is that let's say you bought a structure for a house for $100,000. If you want to get an appraiser, you can, but assume let's say 20% is land cost. So you must invest another $80,000 with the capital gain money for you to get the benefit of this triple tax advantage. Okay, so I hope that's clear. The next question is, can you receive the cash flow? Yes. Can you receive the cash flow from this investment during the holding period? Ed's question. Ed, you're right. You can also get the benefit of current. Let's say, for example, we bought a property, you renovated it, you rented it. So you collect all the rent, you collect all the income from it. That's yours, and it will be subject to the regular tax consequences, like an ordinary rent income tax and so on and so forth. The returns that I demonstrated were not annualized or cumulative. That were just what I paid for the property, what I invest on rehab as the total cost, and what I sold it for. So the difference between two numbers is the same. One of the things that happens in some of these areas that sometimes it may take longer to rehab a property, as opposed to, let's say, normal. It's just some of the challenges that you get in the property. You may not get the right contractor and so on and so forth. And there is no benefit to an investor who does not have an existing capital gain. This is purely to do the capital gain. And one of the reasons they have this specifically for capital gain is because if you look at the IRS and Economic Innovation Group, and I think WNYC survey, they estimated roughly $6.2 trillion worth of capital gain is sitting in corporate and individual books. 4.2 is the individual and the rest is corporate. While we have this kind of wealth sitting in one pocket, on the other pocket we have poverties and extreme deprivation. So the intent is to take that money out from wealthy pockets and bring it into those areas where the capital can reignite, revitalize the communities. Okay, so next question is, can you forward example of how you pass the 90% asset test rule costing? Yes, Jeffrey, I will do that. You can send me an email and I can send you the actual language and how the 90% asset test rule apply, or you can go to form 8996 and it's clearly written in the instructions. 31 months to complete the rehab. Okay, there's another question. What is the minimum purchase cost? To my knowledge, there is no minimum cost. If you have a capital gain of 10,000, you can put 10,000 to work by buying a stock in an opportunity zone corporation. The next question by Robert is that, can I distribute my property in an S corporation or partnership to the shareholder partner and hold the property and invest the cap gain in an OZE? Again, Robert, it has to be an arm's length transaction. You cannot sell it to yourself, nor any partner who owns more than 20% ownership can sell it to themselves. That's a disqualified transaction. Okay, Divya, any more questions that you see?
Let's see. What is the estimated cost of establishing a QOF?
Okay, that's question by Gurvinder. This is a brand new area, and if you're so there are two ways you can invest in a qualified opportunity fund. One would be a C corporation, and the other would be like an LLC or a limited partnership, or let's say C corporation or a partnership. Let's say, for example, you create a simple LLC, then whatever it costs to build that LLC, and you need to have the documentation that complies with the opportunity zone guidelines. So an attorney can probably answer that question better, but my guess is that few $1,000s. If you're establishing a corporation, the benefit is that you can distribute or you can sell shares in that corporation, and people can sell the share, not wait for the property to be sold at the end. So that's the benefit of a C corporation as well as partnership. That's the difference between the two. The next question is that by Byron is that, if you have purchasing a property for 100,000, do I need to have 100,000 in my pocket? If you're buying a property for $100,000 and let's say your capital gain is 50, then but you need to have rehab money also. So you can borrow the money, enough money to buy the property and rehab. But the extent that your taxes, capital gain taxes, will be deferred, reduced, or eliminated will be limited to the capital gain you have. The next question is that the rule that applies to new usage, if you were to buy a property without a certificate of occupancy, well, that's a permit question. I'm not 100% sure. Glenn, I can answer it. I can research and get back to you. In my knowledge, if you're buying a property without certificate of occupancy, you may have cost and things that you need to do to make it to bring it to compliance. And I have no idea if you can do that within 30 months or you're going to go beyond 30 months. Okay, if an Rex has a question. If an investor has no gain to defer but wants to put $1 million in an opportunity zone investment and it appreciates to $3 million, does the investor get the capital gain tax treatment on the $2 million if sold after 10 years? My understanding, Rex, is that that's a very good question. My understanding is that you must start with a capital gain to begin with. So I'm not clear on it, and I have never read anything that says that you can put a regular money. So forgive me, but I will probably can research and get back to you on that. Nathan has another question. Um, Only QO's opportunity zone fund you have seen are all limited to accredited investor. What is your experience? That is true. So Nathan, my suggestion would be that you can then engage an attorney, find the property in an opportunity zone, and you can go ahead and do it yourself. You don't need to, you can, or you or your client can do that. They don't have to worry about being accredited investor. That is only applicable if you're raising money from a public pool and you're advertising as a fund. If you're doing it yourself, I don't think there is any problem that you will have. How can I locate an opportunity zone property? Is IRS website only has numbers, Aaron? So Aaron, there are several maps and I probably can share a link with you, or if you just Google opportunity zone map, EIG, Economic Innovation Group, has several funds have the maps. The maps are very neat. You just go to the right corner, you put in the address of the property, and it will bring you right to that box where blue or orange or blue or brown color, you will see whether your property is or not in that particular census tract. Can the capital gain be created? Charles has a very interesting question. Can the capital gain be created through a sale of a property to the QOF? Yes, you can sell the property to a QOF. You will have the capital gain, but you cannot invest in the same QOF that money. I think so. Okay, I think let's go to the next question. Okay, I think Dave, I don't see any more new question. I don't know if you do.
No, I think that is just about
There's
it.
one question here. There is a risky proposition. Oh, a client bought a commercial property in 2016. It can very well be that it is in an OZEC. Does this qualify? Christy had that question. I am not sure about 2016, but 2017 properties that were bought, I think there is an amendment you can do. You need to, Christy, I am not 100% sure. I have not seen that question asked before, so we probably had to do some research, or you can call me offline and I can help you direct it to the right site. Robert has another question. Can you have a mortgage on a property? Yes, you can. Peter said, actually, S corporation also qualified to be qualified opportunity fund. I have not seen S corporation specifically being mentioned, so I want to be a little more careful and not direct somebody to do that. But Peter, if you're sure, then I would stand corrected. Not a problem. Okay, do I need to use a fund, or we can just set up a business in a qualified opportunity zone? Jeffrey, yes, you can set up a business in a qualified opportunity zone, but you still need to establish a fund to be able to do that. I think Nathan's question I answered. The basis is subject to that. Can money be invested to put on an addition, an existing property in an opportunity zone by the same owner? I don't think so, because you need to bring in, if the property is owned by the existing owner before 2017, I'm not sure if it can qualify. Sorry, George. The next question is that it looks like a risky proposition with limited long-term benefit. Who or what kind of investor should this be recommended to? Craig, that's a very good question. People who have an appetite to take this kind of risk obviously would be the right people. I know a lot of people, like I have several properties in Newark, several properties in Wyandanch, and I know a lot of other investors who are investing in it without any capital gain tax benefit. So that I think that is working. How Glenn has a question. How is the subsequent refinance treated on a property to pay cap gain tax by the December 2000? Yeah, you can refinance and pay the taxes. That's not a problem. Jeffrey, can you still purchase with the debt? I think I answered it. 90% test, I think we answered it. Okay, Fred has a question. What is the probability for an investment in opportunity zone to fail? What is, yeah, certainly property can fail. I mean, so that's why you need to have a proper analysis of the investment done, Fred, before you make the investment. Dave, I don't know how much time I have, or I see a
Yeah,
lot more questions here.
we're well. So I think we've answered just about all of them. I've been crossing out some of them which you may not see updated yet. So the only one I saw that did not get answered, Aaron asked, which states allow the deferral or elimination?
Okay, so that my understanding is that New York and New Jersey do allow. So again, there are 50 states and 5 territories. So I did not go to every state's website. I went to several, and you can then state by state have the right to decide whether they will or they will not mirror the the benefits offered by the federal government. So I think unfortunately you need to go and do that.
Okay.
Okay,
I
William
think
actually answered a very good question. I want to thank him. Page 46 of the proposed regulation, they said that the S corporation is allowed. So I stand corrected. S corporation are allowed. There are a couple of different interpretation of that, so that's why I didn't want to take the risk. But thank you.
Okay, sounds great. I think that just about covers it, and we are almost at the top of the hour here. So, Rakesh, thank you so much for your time today and for answering all of these questions that have come in. This has been incredibly useful for our audience.
And Dave, people can email or ask more questions, and as I dig more, and if I come up with more tools or things that are advantageous to our audience today, I'll be very happy to share them with you, and you can pass them along to them. I think this is a great brand new area that a lot of people can take tremendous advantage of. And as the rising tide lift all the boats, every new investment that is made can add to the existing investment. So I think this is a great opportunity for us to create an impact in America and revitalize these communities that deserve our help. We cannot have poverty in our backyard. So the motive or the intent of this law is good. And if you all work with the proper diligence, I think we can deliver good results to our fellow citizens.
That sounds great. Well, thank you so much, Rakesh. Thank you to all of
My
you
pleasure.
who have attended today, and we look forward to seeing you at another Accountants World webinar soon. We'll be sending out emails about that. Also, a reminder: as soon as we close out of this window right now, you're going to see the post-webinar survey come up from GoToWebinar, and that is your final requirement in order to get CP credit for this. And we'll be verifying CP credit or eligibility over the next few business days by early next week, and you should receive confirmation of that at that time. So thanks again
Thank
to
you, Dave.
everybody who
Thank
joined
you
us
very
today,
much.
and thank you very much, Rakesh.
My pleasure.